They said it wouldn't happen again. But here we are. Zero down mortgages are back. If that sends a chill down your spine, you're not alone. For many, the phrase 0% down is a flashing warning sign from the 2008 housing crash. And yet, in 2025, lenders are reintroducing these loans, not as a relic of the past, but as a solution for the future. So why now? And more importantly, is this your golden opportunity to buy a home or the start of another dangerous bubble? In this video, we're breaking down everything. How these 0% mortgage programs work, who they're really helping, and what the risks are if things go south again. Because if you're a first-time buyer feeling squeezed by high prices and interest rates, this might feel like your only shot. But before you sign anything, you need to hear the full story. Would you take a 0% down mortgage if it meant getting into a home this year? Drop your thoughts in the comments. I'm curious what you'd do. In 2024, United Wholesale Mortgage, UWM, one of the largest lenders in the U.S., made headlines with a bold move. They rolled out a zero-down mortgage program, not a teaser, not a special promo, a real path to homeownership without putting a single dollar down up front. Here's how it works. You take out a first mortgage covering 97% of the home's value. The remaining 3%, that's covered by a second mortgage, interest-free, and only repayable when you sell, refinance, or pay off the loan. It's available exclusively to first-time home buyers earning less than 80% of the median income in their area. In short, it's designed to help renters finally break into the housing market. And UWM isn't alone. This year, we've seen a quiet but steady return of similar loan structures, zero down offers, second line assistance, and even down payment grants that never need to be paid back under certain conditions. The reasoning? With mortgage rates still hovering near 20-year highs and home prices refusing to budge, many buyers are stuck. They have stable income but can't save fast enough to keep up with skyrocketing down payments. To lenders, the answer is simple. If people can afford the monthly payment, let's find a way to get them in. But the stakes are higher than ever. We've seen this movie before, and we know how it ends when loan standards drop in pursuit of volume. Still, to a generation shut out of home ownership, this might look like the only lifeline they've got. So the question isn't just, are 0% mortgages back? The real question is, should you trust them this time? The US isn't the only country bringing back no deposit mortgages. Across the Atlantic, the UK is rolling out its own version of the zero down dream, only theirs is even bolder. In 2023, Skipton Building Society launched the first 100% mortgage in the UK since 2008. No deposit, no parental help, just proof that you've been paying rent consistently. And guess what? It worked. Other major lenders like Halifax and Barclays quickly followed suit, offering similar products with a few added conditions, like a guarantor or income minimums. The logic is the same. If you've already been reliably paying $1,500 in rent, why not let that qualify you for a $1,500 mortgage payment? But critics aren't sold. In the UK, these loans come with significantly higher interest rates, a trade-off for skipping the down payment. And if the market dips, buyers could find themselves with negative equity, owing more than their home is worth. It's a risky game that feels eerily familiar. Yet, for governments and lenders under pressure to solve a housing affordability crisis, these programs are politically popular. They promise hope to an entire generation priced out of ownership. So whether you're in Detroit or Manchester, the trend is clear. Banks are getting creative again. The real question is, are they being responsible or just setting the stage for the next crisis? Because what starts as innovation can quickly turn into speculation. Let's be real, saving for a down payment is brutal right now. Between rising rent, inflation, and stagnant wages, stacking up 5%, 10%, or 20% for a home feels nearly impossible. That's why zero down mortgages are grabbing attention. They remove the single biggest barrier to entry. For first-time buyers, this isn't just a convenience, it's a game changer. Suddenly, the dream of owning a home doesn't require years of saving or a generous family member with cash. Instead of waiting 5 more years, you could buy now, build equity, and lock in a home before prices climb even higher. These loans also allow renters to convert their rent payments into ownership, Think about it. If you're already spending $2,000 a month on rent and you qualify for a mortgage with the same monthly cost, why not redirect that toward building wealth? For people living in high-growth areas where prices rise faster than they can save, a zero-down mortgage may be their only shot at keeping up with the market. And it's not all smoke and mirrors. Some of these programs come with no private mortgage insurance, PMI, and no interest on second loans, making them more affordable than traditional low-down payment option. Of course, these benefits don't come without risks, but for the right buyer, stable job, solid credit, and plans to stay long-term, it can be the launch pad to financial freedom. But is speed worth the risk? That's where we go next. Do you think these programs are helping buyers or just setting them up for long-term debt? Sound off in the comments below. This one's definitely up for debate. If zero-down mortgages sound too good to be true, well, they might be. Let's start with the biggest risk, negative equity. When you buy a home with no money down, you own nothing from day one. If the market dips, even just 5%, you're already underwater. That means if you need to sell, refinance, or move, you'll owe more than the home is worth. And that's exactly what triggered a wave of foreclosures in 2008. The second issue, higher long-term costs. Some of these 0% mortgage programs come with steeper interest rates or fees built into the loan. Even if the monthly payment looks affordable now, you could end up paying tens of thousands more over the life of the loan. And then there's the false sense of security. When someone buys a home without putting any money down, they've got less skin in the game. Statistically, that's linked to higher default rates. Why? Because when the going gets tough, it's easier to walk away from a house you never invested in. Zero-down loans also reduce your flexibility. Since you don't start with any equity, it can take years before you can refinance, pull equity, or trade up. If interest rates drop in a few years, you may not even be able to access them. And let's talk about lender risk. If these programs grow too fast and standards drop too low, we could see another wave of bad loans hit the books. That's not just a risk for buyers, it's a systemic risk for the whole market. Finally, there's the personal financial trap. Buying too much house just because you can. When the down payment hurdle is gone, it's tempting to stretch your budget, especially in competitive markets. That's a recipe for stress and potentially foreclosure if anything in your life shifts. So yes, zero-down loans can open doors, but they can also lock you into a fragile financial situation if you're not careful. This isn't fear-mongering, it's a warning. You can absolutely make it work, but only if you walk in with your eyes wide open. While zero-down mortgages are making headlines, housing experts aren't exactly throwing a party. Mike Calhoun, president of the Center for Responsible Lending, recently warned that these programs could open the door to risky lending behavior if not carefully managed. Translation? We've seen this before, and we know how it ends when banks get too loose with the rules. Even Fannie Mae and Freddie Mac, which back many U.S. mortgages, have treaded carefully with low down payment programs requiring strong credit, stable income, and homebuyer education. Why? Because without these guardrails, the chance of default skyrockets. Financial advisors echo the same concerns. Zero down doesn't mean zero cost. You're still buying a home, says personal finance author Tiffany Elish. You're just postponing the cost and potentially paying more in the long run. But it's not all negative. Some experts argue that, if done right, these programs can be life-changing tools. When paired with financial literacy programs, strict underwriting, and buyer counseling, they can help close the home ownership gap, especially for minority and low-income buyers who've historically been locked out. The key, they say, is to treat these loans like power tools, useful when handled properly, but dangerous without training. Bottom line, experts aren't against 0% mortgages. They're against reckless lending. If you're financially ready and well-informed, this could be your shot. But if you're leaning on emotion or desperation, you could be stepping into a trap with a smile on your face. So here we are. Zero-down mortgages are back, and they're not just a marketing gimmick. They're real, they're growing, And for many, they feel like the only way into a housing market that keeps moving out of reach. But just because you can buy a home with no money down doesn't mean you should. These loans can be a launch pad or a landmine. It all depends on how you use them. If you've got stable income, a strong credit score, and a long-term plan, a zero-down mortgage might just be the break you need. But if you're hoping to get in now and figure it out later, stop. The cost of a bad decision in this market is brutal. This isn't about fear. It's about strategy. You need to run the numbers. Talk to a trusted advisor. Compare the long-term cost of buying versus renting in your specific area. Because in some cases, waiting and saving may still be the smarter move. Now it's your turn. Do you think these new 0% mortgages are a smart solution or a ticking time bomb? Drop your thoughts in the comments. And before you go, like and subscribe to keep updated and make sure you watch my other videos.